Okay, so we were sent a video from a subscriber from Forex Wizard. The title of this video is How to Find Liquidity in Trending Market 1. Now, full disclosure, before we go ahead and watch this video and I give you my feedback, I have never traded Forex and I don't plan on doing it. But maybe this video is still applicable to kind of general market knowledge. And so what I'm going to do is I'm going to watch the video and then I'll give you my feedback. So let's refresh and go.
See how this trader is explaining liquidity.
So let's assume that it is a trending market, okay? Creating series of higher high and higher low. So which is not gathering any liquidity. Once the market breaks to this level, when this swing low is violated, this is where the most amount of liquidity triggers. Because as this is a place ideal that the price will respect, there is a lot of stop losses or break-even trade or the trail. Some people trail their stop loss and they will put below the swing low as an ideal scenario. And when the market drops down to that, this is where the liquidity. Now it's not the end. You will see sometime it will drop to this level. So you don't know. This is the question that I got from you, that either it's going from here or from here. You will understand it by the price action.
See how this trader.
So he's definitely right. Let's go back to that part in the video. This guy is explaining liquidity. Forex Wizard.
So let's assume that
is definitely right.
Market, okay?
What he's drawing here are a series of higher highs and higher lows, which is typical at this point of bullish price action. And what he is talking about is below the latest, right there. So what he's talking about is spot on, is 100% correct. And I think about it a little bit different than he does. So he's right. That is where a good amount of liquidity more than likely is. But the way I think about it is this. Where are the retail traders going to provide that liquidity? And on a trending market to the upside with a series of higher highs followed by higher lows, which is if you look at a trading 101 textbook, is bullish price action. What everyone will do, especially the retail, especially the non-professional, is they will continue to increase their stop losses and move their stop loss orders higher to be above the previous low, right? And their thesis is that is where this bull trend will be negated if a lower low is made or the market moves below the previous higher low. And that's totally true. And I will tell you from personal experience, when I intraday trade, which is maybe 2 or 3 days a week, depending on my schedule, when I intraday trade, I personally am always looking for these levels. It's funny that he kind of pointed it out, but I personally am always looking for these levels because I know retail traders will 1000% have their stop loss orders there. And when stop losses, remember, those are market orders. So you place a stop loss, and if the price reaches that level, the broker will automatically place a market order to exit that position. Right? That is going to be a level where a lot of liquidity is going to be provided because all of the non-professionals, all of the retail traders, all of them, not most of them, not some of them, all of them will always be placing their stop loss orders, again, if it's a trending market to the upside, below the previous low, and if it's a trending market to the downside, above the previous high. That will always be the case. And this gentleman here, Forex Wizard, is totally right. That is where a lot of liquidity is. So when I intraday trade, if I see some sort of an entry, I get even more excited if that entry is potentially followed by a level where I know the non-professionals and the retail traders are going to have their stop loss orders because I know the market's going to slice right through that for the most part. Now, it doesn't always happen, but way more times than not, it does happen. So Forex Wizard's totally right. Again, I don't trade Forex. I don't plan on trading Forex. But the reality is sometimes it is best to consider what the non-professional is thinking, what the non-professional is likely doing, what the retail trader is potentially doing. Because in way more cases than not, you kind of know how they would operate. And those are interesting targets interesting pivot points and also interesting levels where, hey, if we've been trending up for quite a while, especially, right, the bigger that trend of higher highs followed by higher lows happens, the more of those retail and non-professional traders are going to have their stop loss placed at the exact same level. The more liquidity is there, the more market orders will be triggered. You know, there are algorithms, for example, in the oil market where all they do is hunt directly below the previous low or hunt directly above the previous high because they're fishing for liquidity. So there are algorithms that professionally do this. And also, again, when I'm trading, if there's a big trend going in one direction, for example, and I see a good entry point, and I see that right after that entry point is a level that is very likely to have all the stop loss orders from the retails or the non-professionals, I will be happier that that opportunity exists because of that. So this person's right. And again, and sometimes if you just ask yourself, where is the non-professional? What is the non-professional? What is the non-professional? What is the amateur? What is the retail trader likely doing here? I should do the opposite. A lot of times it really works in your favor.